For the longest time, we all thought we knew what financial risk was. But what if that whole idea is just, well, outdated? Today, we're going to dig into how our understanding of risk is going through this massive, massive change. All right, let's get into it. So let me just ask you straight up, what if risk isn't what you think it is? Seriously, what if the real danger isn't just the market bouncing up and down every day, but something deeper? We're about to flip some of the oldest investing assumptions on their head. You know, for years and years, Wall Street had a super simple way of looking at risk. They just called it volatility. You know, the ups, the downs, the whole roller coaster. But then, 2008 happened. And when the markets just went into an absolute free fall, I think everyone kind of realized, wait a second, the downs feel way different than the ups. So this old way of thinking, it has a name, Modern Portfolio Theory, MPT for short. And this thing is basically the foundation for a ton of financial strategy. Its main idea, and this is wild, is that any big swing away from the average is risk. Doesn't matter if it's a huge win or a total disaster of a loss. To MPT, it's all the same. It just throws the good, the bad, and the ugly into one big bucket. And this Longfellow quote, it just nails how MPT sees the market. Think about it. A stock that shoots up 30% is seen as just as risky as one that crashes 30%. It's all just volatility to the theory. But come on, as an investor, you and I both know that's not how it feels, right? We'll take those very good days all day long. It's the horrid ones we're trying to avoid. So all that dissatisfaction with the old way, it sparked something new, a new way of thinking, a challenger to the throne, you could say. And this sets the stage for a really cool showdown between two very different ideas about how to handle your money. Okay, this right here gets straight to the point. On one side, you've got MPT, the theory that says all volatility is the enemy. But on the other side, you have Postmodern Portfolio Theory, PMPT, and it makes one tiny but absolutely crucial change. It says, nope, we only care about downside risk. In other words, PMPT gets what we all get. The only risk that really keeps us up at night is the risk of actually losing our money. Here's a great way to think about it. MPT is kind of like a driver who's scared of all speed, all the time. Hitting the gas on a wide-open straight highway feels just as dangerous to them as flying towards a hairpin turn. But PMPT? That's the smarter driver. That driver knows speed itself isn't the issue. It's the speed that's gonna make you crash. It just makes more sense, right? And look, this isn't just some dusty old academic argument. Let's look at the real world, the 2008 crisis. The numbers are pretty stark. The old-school MPT portfolio got absolutely hammered. It lost nearly 40%. Ouch. But the PMPT portfolio? I mean, it still took a hit. Nobody was safe. But it did so much better, capping the losses around 24%. It was like a shock absorber for your money, and it proved its worth when things got really ugly. Okay, but here it comes, the million-dollar question. What's the catch? Come on, you know in finance there's always a trade-off. All that amazing protection when the market is tanking, yeah, that doesn't come for free. And this chart, this is the other side of the coin. It shows what happened after the crash, during that long run of good years. And what do you see? The old MPT portfolio actually grew more. It outperformed the safer PMPT one. And that's the price you pay. That safer strategy can sometimes mean you miss out on some of the upside when the markets are good. This all boils down to a concept called the asymmetry penalty. Basically, think of PMPT as a really, really good but expensive insurance policy. It is an absolute lifesaver when a hurricane hits. But what about all those calm, sunny years? Well, you're still paying the premiums for that insurance. And that cost can start to add up and drag down your overall growth. It's protection you paid for, but thankfully didn't need. So what does this all mean for, your retirement fund? Well, this whole debate is actually the fundamental choice every single one of us has to make with our money, whether we know it or not. Is your goal to build a fortress that can survive anything, even if it grows a bit slower? Or are you shooting for the moon, trying to get maximum growth, but knowing you're more vulnerable to a crash? And there's no easy answer here. But just when you think you've got it figured out, this is where our whole story takes a huge turn. Because this entire fight between MPT and PMPMT, it's all based on one big assumption, that risk is just about numbers on a stock chart. But what if the biggest risks we face today have nothing to do with market volatility? The truth is, the very map we use to find financial risk is, well, it's been totally redrawn. We're leaving the world of simple price charts behind and stepping into a reality that's way more complex and way more connected. I mean, just think about it. For a portfolio to be truly strong today, it has to consider a whole new playbook of threats. What's the real financial cost of a superstorm made worse by climate change? Or a cyber attack that just destroys a company's trust with its customers? Or a sudden trade war that snarls up everything? These aren't things you can track with a stock ticker, but man, they can absolutely wreck an investment. So how in the world do we even begin to measure these new kinds of risks? Well, this is where the conversation shifts to three letters: E, S, and G. Environmental, social, and governance. It's a new way of asking questions. How is a company dealing with its environmental impact? How does it treat its people? Is its leadership team honest and accountable? Looking at this stuff gives us a completely new way to see how well a company can actually handle the real threats of the modern world.
And let's be clear, this isn't just some passing fad. This is getting hardwired into the financial system itself. We're seeing new regulations pop up all over the globe that are requiring companies to come clean about these risks. It's a fundamental change in what we expect from businesses. What used to be a little corporate responsibility checkbox is now becoming a must-have for figuring out what a company is truly worth.
So let's wrap it up with this idea. That whole debate between the old and new portfolio theories, it was important. It taught us to be smarter about market crashes. But the real leap forward, the real evolution, is realizing that financial risk isn't just about finance anymore. Maybe the biggest risk we can take is to keep using yesterday's definition of risk to try and navigate the world of tomorrow. So the real question I'll leave you with is, what does risk really mean to you now?